There is $1.7 trillion in student loan debt sitting in the American economy right now. And if you think that's only a problem for the people who borrowed it, you are about to get a very expensive education. Most finance channels cover student debt as a personal finance story. Budget better. Pay it off faster. Here are your repayment options. That is not the full picture. What I found when I mapped this system end to end is a structural financial crisis that directly threatens your housing market, your retirement portfolio, and your small business, whether you ever borrowed a single dollar for college or not. The data suggests this bubble is already cracking, and the people who understand what's coming are positioning right now. Stay with me, because what I'm about to show you changes everything. By the way, if you're new here, my name is Alex Carter. I've been working in personal finance for 8 years. In these 8 years, I've helped hundreds of people solve real money problems. And honestly, some of those people's lives completely changed because of it. On this channel, I help everyday people understand the macro financial forces shaping their economic reality and what to actually do about it. All right, let's get into it. Let me give you the human scale of this number first, because $1.7 trillion is the kind of figure that stops meaning anything the moment you hear it. My situation a few years ago was this. I was working with a 34-year-old client, smart, employed, earning $67,000 a year, who had $94,000 in federal student loan debt from a master's degree she finished 8 years earlier. She had been making payments for 8 years. Her balance had gone up. Not down, up, because the interest rate on her loans exceeded what her income-based repayment plan required her to pay each month. She was paying every month, on time, and still going further into debt. That is the average American student loan experience, and it's brutal, okay? Loan balance chart showing a borrower making monthly payments for 8 years with the balance growing rather than decreasing due to interest accrual. Now scale that to 45 million borrowers. That's how many Americans currently carry federal student loan debt. The average balance is approximately $37,700. But the distribution is not even. Approximately 7 million borrowers carry balances over $100,000, and that group holds a disproportionate share of the total $1.7 trillion. And here's the thing nobody tells you about student debt that makes it categorically different from every other type of debt in existence. You cannot discharge it in bankruptcy. A person who ran up $80,000 in credit card debt through bad decisions can file for Chapter 7 bankruptcy and walk away with a clean slate in approximately 90 days. A person with $80,000 in student loans cannot. They carry that debt through unemployment, through medical crisis, through divorce, through every financial catastrophe life produces, and it follows them until it's paid off, or they die. In some cases, as Caleb Hammer discussed on Joe Rogan, it follows people into retirement, with Social Security payments being garnished to cover student loan defaults. People in their 60s and 70s having retirement income docked for loans they took out in their 20s. That is not an edge case. That is the mathematical end state of a system designed to make this debt inescapable, okay? Keep watching, because what comes next is the part most people never figure out, how this crisis is spreading globally right now. The United States is not alone in this. And this is the piece that almost no finance content covers because most creators are US-focused and miss the international pattern entirely. The United Kingdom's student loan system crossed £200 billion in outstanding debt in 2023. The average English graduate now leaves university with approximately £45,000 in debt, and under the current repayment system, the majority of graduates will never fully repay their loans before the debt is written off after 40 years. The UK government knows this. It's built into the model. Canada's student debt load crossed 30 billion Canadian dollars at the federal level, with additional provincial debt on top. Australia's HECS Help system, which indexes student debt to inflation, saw outstanding balances jump by approximately $9 billion in a single year when inflation spiked, meaning graduates woke up owing significantly more money than they borrowed without making a single bad decision. For developed economies, the same pattern. Education costs rising faster than wages for 30 consecutive years, lending expanding to fill the gap. Graduates carrying debt loads that structurally suppress the economic behavior that drives housing markets, retail spending, and business formation. This is not a coincidence. This is the identical policy architecture applied simultaneously across multiple countries, and it is beginning to crack in all of them at the same time. Okay? World map highlighting US, UK, Canada, and Australia, with student debt figures displayed for each country simultaneously. Stick with me. This next part is where everything changes for investors and homeowners who think this has nothing to do with them. Here are the 3 economic dominoes, and this is where your personal financial exposure becomes real, regardless of whether you ever took a student loan in your life. Domino 1. Housing demand suppression. The median age of first-time homebuyers in the United States has risen from 29 in 1981 to approximately 35 today. Multiple Federal Reserve studies have directly linked student debt load to delayed home ownership, finding that a $1,000 increase in student debt reduces the probability of home ownership by approximately 1.5 percentage points. Multiply that across 45 million borrowers, carrying an average of $37,700 in debt each, and you are looking at a structural suppression of housing demand that is permanently baked into the demographic pipeline. If you own property, your home's long-term appreciation trajectory is partially dependent on the next generation of buyers being able to qualify for mortgages. A generation carrying $37,700 in non-dischargeable debt before their first rent payment is a generation that qualifies for significantly less mortgage than their parents did at the same age. That is a direct compression on housing demand, and it is already in the data, okay? The student debt growth overlaid on the same domino too, consumer spending compression. The U.S. economy is approximately 70% consumer spending. That means the economic growth that drives corporate earnings, stock valuations, and your retirement portfolio is fundamentally dependent on people spending money. A 34-year-old making $67,000 a year with $94,000 in student debt is not opening a business. She's not buying a home. She's not maxing out her 401k. She's making a student loan payment and hoping nothing breaks. Multiply her across tens of millions of borrowers in the peak spending years of their lives, 28 to 45, and you have a structural drag on consumer spending that functions like a permanent tax on economic growth. Most finance channels cover this as a social issue. It's not. It's a macroeconomic variable that directly affects the S&P 500 earnings trajectory that your index fund is betting on. Okay? Domino 3. Default cascade risk. Here's the data that suggests the bubble is already cracking. After the federal student loan payment pause ended in October 2023, the Department of Education reported that approximately 40% of borrowers who had payments resume were behind within 3 months. 40%. Not struggling, not late. Behind, meaning delinquent on the first payments they'd had to make in over 3 years. As of early 2024, approximately 9 million borrowers were in default on federal student loans. That's 9 million people with wage garnishment risk, tax refund seizure risk, and Social Security offset risk, all of which reduce consumer spending directly and immediately. And here's the thing nobody tells you about what a large-scale default wave actually triggers. Student loan asset-backed securities, packages of student debt sold to investors, are held by pension funds, insurance companies, and institutional investors globally. A significant default wave doesn't just hurt borrowers. It hits the balance sheets of the institutions managing retirement assets for people who've never set foot in a university. Okay? Student loan debt packaged into asset-backed securities, then distributed to pension funds and institutional investors globally, with default arrows flowing back through the chain. So you're probably wondering, what do you actually do with this information? You have agency, more than you're willing to accept right now. 3 practical steps. First, if you're a borrower, stop waiting for forgiveness and start running the math on your actual payoff timeline under the standard 10-year plan versus income-driven repayment. The standard 10-year plan is more expensive monthly, but cheaper in total. Income-driven plans keep payments low but balloon the total cost through interest accrual, exactly what happened to my client with the balance that went up despite 8 years of payments. Know your actual number before you make any more passive decisions. Second, if you're an investor, understand that housing market exposure in markets with high concentrations of student debt-burdened demographics carries structural demand risk that isn't priced into most valuations. This doesn't mean sell everything. It means diversify your real estate exposure geographically and demographically. Not all markets are equally exposed. Third, if you have children approaching college age, the single highest return financial decision you can make right now is treating college selection as a financial decision, not a prestige decision. The data on lifetime earnings premium for attending a highly ranked private university versus a well-regarded state school is not strong enough to justify a $200,000 debt differential. The math is simple. People just don't want to sit with it because it feels like they're limiting their children. They're not. They're protecting them from the trap we just spent 7 minutes mapping. Okay? Private university 4-year cost versus a state school 4-year cost, with 20-year financial outcome projections for each graduate including debt service costs. All right, so today we covered the full systemic architecture of the $1.7 trillion student loan crisis, why it threatens housing markets, consumer spending, and retirement portfolios for people who never borrowed a dollar for college, and 3 practical steps to protect your financial position before the next trigger event. If this helped you even a little bit, hit that like button. It genuinely helps this channel reach more people who need this kind of content. Subscribe to the channel and make sure you hit the bell icon so you never miss a video like this. We drop new finance content every week, and trust me, you don't want to miss what's coming next. And if you want to go even deeper on how macro financial forces are reshaping housing markets and what smart investors are doing about it right now, I've linked a video right here. Go check that out next. I'll see you there. Have a prosperous day.